Financial independence is generally used to describe the state of having sufficient personal wealth to live, without having to work actively for basic necessities. For financially independent people, their assets generate income that is greater than their expenses. For example, a person's quarterly expenses may total $4,000. They receive dividends from stocks they have previously purchased totaling $5,000 quarterly, while also having more money in other assets. Under these circumstances, a person is financially independent. A person's assets and liabilities are an important factor in determining if they have achieved financial independence. An asset is anything of value that can be liquidated if a person has debt, whereas a liability is related to debt, in that it is the responsibility of one possessing it to provide compensation. It does not matter how old or young someone is or how much money they have or make. If they can generate enough money to meet their needs from sources other than the primary occupation, then they have achieved financial independence. Age is potentially irrelevant with respect to financial independence. If they are 25 years old and their expenses are only $100 per month and they have assets that generate $101 or more per month, they have achieved financial independence, and they are now free to do things that they enjoy without having to worry as much. If, on the other hand, they are 50 years old and earn $1 million a month but still have expenses above $1 million a month, then they are not financially independent because they still have to generate the difference each month just to stay even. However, this needs to take into consideration the effects of inflation. If a person needs $100 per month for living expenses today, that figure will be $105 per month next year and $110.25 per month in the following year to support the same lifestyle, assuming a 5% annual inflation rate. Therefore, if the person in the above example obtains their passive income from a perpetuity, there will be a time when they lose their financial independence because of inflation. Approaches to financial independence. Since there are two sides to the assets and expenses equation, there are two main directions one can focus their energy: accumulating assets or reducing their expenses. Asset accumulation. Accumulating assets can focus one or both of these approaches. Gather revenue-generating assets until the generated revenue surpasses living, liability expenses. Gather enough liquid assets to then sustain all future living, liability expenses. Expense reduction. Another approach to financial independence is to reduce regular expenses while accumulating assets, to reduce the amount of assets required for financial independence. This can be done by focusing on simple living, or other strategies to reduce expenses. Calculation. A general calculation for the time required to reach financial independence is as follows. An example of someone making $30,000 per year, with yearly expenses of $10,000, paying 25% taxes, with a savings rate of 75%, a net worth of $5,000, and withdrawing 4% per year.